Hi guys, welcome to Accounting with Naomi. Once again, we are going to take you through an accounting video. All right. So in this video today, I want to deal with group's financial statements, and it's going to be quite a series. So you're going to stay here for quite a while because group's financial statement it is a broad topic, very broad one, in fact. All right. So let's get going. So group's financial statements. What exactly is being covered in group's financial statement? First thing first, we are going to have Ifrs. First thing first, we're going to touch on Ifrs 3. Going to touch on Ifrs 3, which is business combination. That's the one I want to touch on this class. So we'll start with Ifrs 3, business combination. Business combinations. And then we'll look at also Ifrs 10. This is the main one. This is the one we're going to stay in for so long. Consolidated financial statement, so which is covered in Ifrs 10. Consolidated financial statements. Okay, and as we go further, we are also going to look at Ifrs 11. Ifrs 11. This one covers joint arrangements. Joint arrangements where we actually get to either get joint venture or joint operation, right? So joint arrangement is covered in here. Right, and also we're also going to deal with IS 28. IS 28, this is where we deal with investment in associate and joint venture. Investments in associates or joint venture. This should be I there, joint venture. Right, basically here, this is where we deal with what you call the equity method. All right, guys. So basically, at the end of the day, this is what I'm expecting. At the end of the day, I'm expecting to see these covered in group's financial reporting, or rather group's financial statements. This is what I'm expecting to cover. Like I said, it's going to take a couple of videos for us to cover this. We're going to eat the cake piece by piece. That's how you understand better. Whenever something is broad, just eat it piece by piece, right? You will see that it actually becomes easier as we go. Now, in this class in particular, I want to deal with business combinations. So in this particular class, I want to deal with Ifrs 3. And so our focus is going to be on Ifrs 3. Okay, so let us get going. All right. Now, the first question you want to ask yourself is, what is Ifrs 3? What is Ifrs 3? What does it entail? What's on business combination? What is it about? All right, so business combinations deal with the accounting treatment and initial determination of the value attached to the subsidiary being acquired on the date of acquisition. This standard deals with the method of accounting for business combinations and their effect on consolidations, including goodwill or gain on bargain purchase arising on a business combination. All right, so we've just given you a bigger picture of what Ifrs 3 business combination wants to deal with. Now we want to get into details. So follow me as we get into the details. So let's get into the details. So we're back here. We are back here. We now get into our details. We are now going to continue. Now, before I go anywhere, before I move anywhere, we need to understand something, right? What are groups? Okay, first thing first, what are groups? So when we're talking about groups, remember we say groups financial statements. What are they? All right, that's the first thing first. If you don't get this, you won't go anywhere. All right, what are groups? So groups basically, these are companies that have, either one company obtained control in another company, or control is obtained where shares are being sold. All right, so you purchase an interest in one company, and then you probably obtain control, or you obtain significant influence, or you obtain joint control. All right, and then it makes up a group. All right, so there are two major groups that can happen, and I'm going to give illustration for you to understand what it means. All right, so there are two major groups. Before we even start with that, no, it's fine. Two major groups. Let's just go. So there are two major groups. Group number one, this is a simple group. Simple group. Right, so that will be my starting point, a simple group. So we're going to make an illustration to gauge our simple group. Let's say, for example, we have company A, right? So company A purchases interest or shares. So they obtain shares in company B. All right, so what happened here? Let's say, for example, they purchased about 85% shares. All right, issued shares in company B. All right, so then what happened? Because of these 85% shares, they have obtained what is called control. So they have obtained control over company B. So company A has now control over company B. All right, there we go. It means that they control the affairs of company B. Company B, when making decisions, so they have the voting rights. When making decisions, they have the majority voting rights. So at the end of the day, it is what they say that goes, because it is the decision that is voted by company A that will go. So what happens then? So this type of company is then called, trying to get a better color, but anyway, it's fine. Okay, let me get blue. So this company, because they have obtained control in company A, this is referred to as the parent company. This is the parent company, and this one will obtain is control is obtained from it. It's referred to as a subsidiary. Now I will be using this word a lot, so please understand what it means. Okay, so the company that buys control or obtains control is the parent company. The company whom control has been obtained by, or whom shares has been bought from, is the subsidiary companies. Okay, company A controls company B. Now, talking about control, before I even go on, there are three things that you need to look out for in control. Now, it is not always true that a company must have 50% and above to have control. Not always. There are other elements that we look at. Okay, so there are three things that we are actually looking at when I'm talking about control. I'm going to change the color again. All right, so to have control, we look at three elements. So element of control, let's go here. Right, number one. So what must happen? You need to have power over the investee. Okay, so number one, you need to have power over the investee, in this case, the subsidiary, the company in which you're investing in. All right. And I'm talking about companies, not an individual. Ne? It's a company buying shares in another company. Right. So you need to have power over the investee. So how do we know you have power over the investee? There are three things we look at as well underneath here. For you to say you have power over the investee, you need to have existing rights. So there must be existing rights. Okay. So by you obtaining shares in them, it gives you the rights. So you have existing rights. That existing right that give it the current ability, existing rights that gives current ability, right? So it's basically, it's like a sentence, but we're cutting it down. So existing rights, current ability to direct relevant activities, to direct relevant activities of the investee. All right, so that is basically it. That's how it works. And so that is the first thing you need. Number two. So in other words, we're still talking about control. To have control over a company, over a subsidiary company, you first of all have to have power over the investee. And to have power, you need to have existing right that gives current ability to direct relevant activities of the investee. Okay, my handwriting. Right. Please bear with me. All right. Then the second thing is you need to have exposure to variable returns. Exposure to variable returns. Now, even if I have less than 50%, I can still have exposure over variable returns. So it's not always true that it has to be 50%. It can actually be less and you can still be controlling the company. All right. You have to have exposure over variable returns. And lastly, you need to have the ability to use its power. Okay, so this power we spoke about there, right? You need to also have the ability to use the power. All right, ability to use its power over the investee, to use its power over the investee, in this case, the subsidiary, all right, to affect the amount of returns, the amount of returns, to affect the amount of returns which it is exposed, If you can do this, if the three are available, all right, so apart from having more than 50%, if you have less than 50%, but use the three elements are applicable, like you have power over the investee by having existing right that gives the current ability to direct relevant activities of the investee, right? So you have power. Number two, you have exposure to their variable returns. Number three, you have the ability to use that power over the investee to affect the amount of returns which it is exposed. So if the three are there, we can be assured that there is control. All right, so that's how you actually do your control test. So it's not just simply having more than 50%. So this is a simple group. In this simple group, coming back to simple group, in this simple group, we have one parent and we have one subsidiary. Okay, one parent, one subsidiary, simple group. All right, so then we are coming out of a simple group. The other major group that we have, let's go back. The other major group that we have is the complex group. Complex group. All right, now in a complex group, there are three types of groups that can be considered complex. All right, so it goes further. We're going further to say now we have, okay, let me stay in there. So I'll call them A, B, and C. A, we have the very first group under complex group is referred to as horizontal group. Horizontal group. Right, so we're going to look at the structure of a graph, all right? So we all know a graph is something like this. Here is my y-axis, this is my x-axis. Now, on my y-axis, this is referred to as the vertical axis. Vertical axis. And this is referred to as the horizontal axis. All right, so we will use this for us to be able to determine the shape of the group, the complex group we're talking about. Right, let's start with the horizontal group. So horizontal group, for example, I'm still going to use company A. For example, I have company A here. Company A has purchased interest in company B. Also interest in company C. Also interest in company D. Actually, it will continue to go on and on. Let's say here he has 65%. Let's say here he has 90%. Let's say here he's got maybe 78%. Now, please note, it can also be a wholly owned subsidiary. It can also be a wholly owned subsidiary, meaning if I buy everything like 100%, okay, which is not so much found in practice. It's not so much found in practice, but it is possible. I can actually buy the full 100%, and I am the wholly owner. I own the company fully. All right. Now, in this situation where they are buying a part, it means there are other owners. And those other owners are referred to as non-controlling interest owners. In short, NCIs. Okay. Because if I have 90%, it means there are people that owns the other 10%. So that's how it works. All right. So in this group, if you look at the structure of this group, that we have company A at the top, which is the parent. Then we have all the other subsidiaries, which they have a direct relationship with every subsidiary. All right. This kind of group is referred to as an horizontal group. Just check. Let's go back to the structure of our graph. If you go back to the structure of our graph, you can see horizontal is going this way, right? Left to right, okay? It's going left to right. That is the relationship they have. So that is the type of group this is, all right? So when I come now, I will name this group horizontal because of the structure it carries. Horizontal group. Right, so that's the structure of this group. It is a complex group, but in a structure of an horizontal axis. All right, so that's how it is. This one is still quite easy. It's even when accounting for it, because it's similar to a simple group, just that they are more subsidiary than one. Okay, there are more than one subsidiary, but because they have a direct relationship, the parent has a direct relationship with all the subsidiary. It's the accounting is almost the same with the simple group. So I'm just going to have many of whatever I would do in a simple group. Okay, so that's how it works. So that's my first type of complex group. The second type of complex group, we call it B. This is referred to as vertical group. This is also a complex group. Right, so vertical group, we're going to make an example. For example, if company A purchased some shares in company B, and company B now purchases shares in company C, and company C now purchases shares in company D. All right. Oh, wow. That's the group here. So here, the main parent, the parent at the top, the main parent does not have a direct relationship with everybody. All right. So let's just do a little illustration. So the main parent has a direct relationship with, if you check here, company A has a direct relationship with company B. But company A does not have a direct relationship with company C or with company D. They do not have a direct relationship. So they have an indirect relationship because it's part of the group. They have an indirect relationship with company C and the rest. All right, how so? How so? So what is happening here before I even go there? What is happening here is this company is the parent of company B. Company B is the parent of company C. Company C is the parent of company D. So even though I have a parent, I am also parenting somebody. I mean, think about it. That's that's our life, basically. You know, I have my parents. When I get married and have my own child, then I too am a parent to my child. If my child grows up and has another child, they will also parent another child. I will be the grandparent, and then my parents will be great-great-parents. So that's the relationship that is happening here. So company A is more like a grandparent to company C and a great-great-parent to company D. So somehow they benefit. That's why I'm saying they have an indirect relationship. For example, let's say company D makes a profit of 100,000. Okay, I'm just giving a simple example just for illustration purpose. Consolidation is not this straight. Okay, this is just a simple example for illustration. So let's say company D makes a profit of 100,000. So let me first of all put how much shares they have. All right. So this one has 60%. They have 85%. It has 65%. Okay, perfect. So we do it like that. So company D makes a profit of 100,000, and then it will then take this 100,000 and give 65% of the 100,000 to its parent. Right, so I'll come here to its parent. So it gave, so we have 100,000 there multiplied by 65%. 100,000 multiplied by 65%. Right, so this is 65,000. Okay, so it's giving 65,000. Remember, guys, I said this is a simple example for illustration purpose. I'm not cutting out all the consolidation and procedures and everything. I'm not cutting it out. I'm just for simple illustration, just for you to see how they are all connected at the end of the day. Okay, so from the 100,000, 65% goes to company C. Now, company C will also share with its parents, right? So then company C goes to company B and will also give 85%. So 65,000 multiplied by 85%. Of that money, it goes to company B. So this multiplied by 85%, it becomes 55,250. This goes to company B. Company B also has a parent, so they will also go and take the 55,000 they received from their subsidiary to give a portion to their parent. So they will give 60% of this to their parents because that's how much they have in them. So 33,150 goes to the parent at the top. So from this 100,000, actually 33,150 goes to the parent at the top. So they all benefit from whatever they're making, right? Now, I am your parent's parent. It means I'm also somehow affecting the decisions that you are making in your company. Okay, some of your decisions in your company is affected by me. So that's how groups works. That's groups financial groups combinations of companies, business combinations, groups. This is how they work. Right, the last group is mixed groups. The last group is mixed. Now this is what you usually find in practice, but when examining this at school level, they usually do not test mixed groups. Right, they usually do not test mixed groups, so I'm not gonna go into much details with mixed group. Basically, what mixed group does is combination. So this one is a combination of horizontal and vertical groups. Okay, so basically, guys, that is how it works. These are the groups that you have. So complex groups is divided into three. Simple group is just there where you have one parent and one subsidiary. All right, so when you start with groups, they start you with simple groups, but as you go further, you then begin to introduce you to complex groups. Okay, so that's how it works, guys. That is business combination. That is business combination. Another thing that I need to know in business combination is basically where we get to the acquisition. All right, when we get to the acquisition, that is a very, very important aspect. Right, the acquisition method, which we're going to deal with this one better when we start with consolidation. And I want to do the next class I want to do is on consolidation. All right, so the business acquisition of interest. Acquisition of interest. Right, in the acquisition of interest. So this is what happened. I'm going to put in a timeline. This timeline will assist us. So let's say, for example, the year begins in January 2024, ends on the 31st December 2024. All right. And so this is my financial period. All right. Every time you're working in accounting, we have what is referred to as financial period or the current year. So that's my financial period, which is usually 12 months, or I can refer to this as the current year. Right, and then let's say, for example, somewhere on the 23rd of March 2023, all right, company A purchased interest in company B. So in this time, this date is referred to at acquisition. This is the at acquisition date. Right, so this is my at acquisition date, and that's my current year. So when I'm dealing with consolidations, which we're going to deal with in the next class, like I said, when I'm dealing with that, and then I have to work with this period accordingly to say this will be my period one, stage one, right? Then you can see there's a period that is falling in between from here to the beginning of here. So I know this period, these dates, I know, but what about these dates? What about these periods that are falling in here? All right, so this type, let me use a different color. In here, the period that are falling in here, these are referred to as since acquisition. So these are very important. These periods fall in between, so we need to know what are the movement that occurs here. So what we usually look for in this period are the movements. Okay, so let's go back again. So there are three stages basically. Stage number one, at acquisition. Stage number two is the since acquisition. Stage number three is the financial period or the current year. All right, so the acquisition that happens in there are a method that needs to be applied to the acquisition. So now I want to focus on my acquisition date, which is on my stage one. On my stage one, there are about 8 steps that you have to go through. All right, we'll deal with this one better. We'll do questions. Remember, we're developing the topic as we're going. I'm just going to list it for now. And then when we actually apply a question, it will make more sense. First thing first in this, so there are methods that must be followed or steps. Should I say methods? Yeah, or steps. At acquisition method or step. Number one, identify the acquirer. Who is the acquirer? The parent. Identify the acquirer, or in short, parents. Okay, parents, remember, they have to have control for them to be a parent. Okay. Number two, determine the acquisition date. So we need to know who is buying. Let's just go to one. Who is actually buying this interest? Who is buying these shares? Okay, that's the first one. Number two, determine the acquisition date. The date that we're talking about here. Determine the acquisition date. Acquisition date. What was the date? Now, this date is when everything is finalized. Okay, so payments are made, documents are signed, it is finalized that this is the day that company A becomes the parent of company B. That's the date we're talking about. All right. Then step 3, identify the consideration transferred. Now, identify the consideration transferred. Okay, this is now is how much was paid. And did we pay with money or pay with items? Now, it's possible to pay cash or to pay with assets or to even pay with other shares as well. Right? It's possible. So usually when they're testing it, they'll test it with either items, usually like your PPE items will be transferred, cash, all right, different items, but let's say machinery, land, or anything like that. So I can pay with items, I can also pay with cash. So we need to identify what was the consideration that was transferred. Number 4, it goes hand in hand. After we identify the consideration that was transferred, we need to measure the consideration. So then measure the consideration transferred. Now, this consideration that is transferred, if it's money, it's easy. Money, they'll just tell us the value. That's it. We use the value that is being given. But if it's an item, for example, land, we have to measure this at fair value. All the property, plants, and equipment items are measured at fair value. Right? If it's an investment, to be measured at the fair value of the investment at that moment. Equity, we measure it at the market price of the share at that moment. Okay, so that's what we basically do. It's the fair value and the market price of the day that is being transferred. Okay, once we're done with that, remember there are 8 steps. Step number 5, identify and measure identifiable assets acquired and liability measured. So it's identify and measure. After you've identified, then measure the identifiable assets that are acquired and liabilities that are assumed. Okay, so what we need to do at that date, at acquisition date, we need to measure the asset that we have. Okay, so we check the market price. We compare the market price, the market price or the fair value. We compare it to the carrying value or carrying amount in the business. All right, for example, if land is sitting right now with 1 million, but in the market the same land is actually 1.2. So we have to adjust for revaluation to say no, land has actually been revalued. It is not 1 million like we're thinking, it's actually 1.2. All right, that's what I'm talking about. We do the same for all the other assets and liabilities. Remember, with them may come, so let's just say we may have adjustments like revaluation, surplus, inventory written down, and all of that. adjustments will come with the tax effect. So you have to remember that these items will also have tax effects. All right, so basically that's how it works. Then we have, so that was step number 5. We go to step number 6. Step number 6, it says now measure the non-controlling interest. Measure the non-controlling interest, and in short NCI. Remember we said if you do not own 100% of the company, it means there are other owners. Okay, there are other owners that are also available there. Like even if they own 10% or 15%, they are also owners, and we have to measure them. Now measuring these can come in 2 methods, right? It can either be measured at proportionate share, at proportionate, or it can be measured at fair value. Right, when it's measured at fair value, that's when NCI will also have goodwill or excess. Okay, right. Then number 7, step 7. So after I've measured my NCI and every other measurement that I've done, then I need to determine the amount of goodwill. Goodwill. So then let me rather say calculate goodwill. We'll deal with this one in detail as we go. Or gain on bargain purchase, also known as excess, actually. That's what I meant here. Anyways. All right. So calculate goodwill. We'll get in this one in detail as we go. Let's not, the video shouldn't be too long. The video is already too long. So I will cut this one soon and then we'll continue with the second video. We'll take it from there. Right. Then the last thing after that, account for any measurement period adjustments. Account for any measurement period adjustments. All right, guys, all of these that we have touched on is coming from Ifrs 3. Remember in the beginning, I did talk about different standards that are affected in terms of groups. So far, we have touched on Ifrs 3 business combination, and we are going to develop this. The next class, I want to look at consolidation. Please stay tuned. Don't be far. Now, please share our links around. There are people that will really need this content and are going to benefit seriously from this content. If you are a student, share with your other students. Share our links. Let people talk about us. We are here to help you and make sure you help us also to get our content everywhere. All right, guys, thank you so much for staying up until this long. I'll see you guys on the next video. Please don't forget to subscribe. Don't just watch. Please subscribe. In fact, subscribe now. Subscribe. Please like the video. Comment on the. Tell us what you like about the video, how we can improve, and which videos do you suggest we should do? Which topics are you suggesting we should do? Put it on the comment section, okay? Thank you so much for joining. Thank you so much for being here, guys. See you on the next video. Bye.